financing growth from banks' point of view entails assessing two questions: availability of growth capital and garnering enough lendable resources to fund growth. At the macroeconomic level, for the first leg of Viksit Bharat, that is time horizon up to 2036, we envisage a growth rate of at least 8 to 9% on an average. This rate can be achieved if we can increase the investment rates to 35% by 2036, approximately 200 basis points higher from the current levels in 2024. Thus, the domestic saving rates must rise from the present level by at least 350 basis points to 33.5%, so that CAD stays around 1.5% of GDP, its long-term sustainable level for India. This back of the envelope calculation shows that capital markets must gear for additional supply of savings to the tune of 3.5% of the GDP over and above what is presently coming in as annual inflows. Further, we must keep in mind that these incremental flows will come from a segment that is young, who have a different risk appetite and outlook on investment. It is important that institutional arrangement such as the mutual funds and primary markets look at this as an opportunity so that these savings are channelized into productive sectors of the economy and do not flow into derivative segments, as has been the case in recent years. This also calls for greater focus on investor protection and investor education. On the demand side, we find that higher investment rates of 35% will require at least 127 lakh crore of funds in corporate bonds, assuming the size of the corporate bond market at 30% of GDP. At the conservative level of credit to GDP ratio of 75%, the cumulative funds from the banking system amounts to 323 lakh crores. So when we aggregate all the sources of external finances, bank borrowing and corporate bonds, then at 70% debt to equity ratio, we need equity mobilization of 643 lakh crores by 2036 to support the envisaged growth by 2036. This is something, which we need to ponder how this depth in the equity mobilization is achieved.